And good afternoon. It's Peter Klein, Chief Investment Officer, co-founder of ALINE Wealth, with you in the Wednesday, the 12th of October, after the market closed. And I want to make sure I bring this bunch of information to your inbox and to allow you to sort of ruminate on it over the course of the next few days. Clearly, there's been a fair amount of volatility in the markets, and with that, as our mandate here at Align Wealth is always to communicate with our clients, I felt like it was a good idea to bring this treasure trove of slides to your attention. So let's go through it. We call it New Regime, New Playbook. Okay, regime change. As we have spoken about over the course of the last, well, it's been about 18 months. We had, as you remember, in the spring of 2021, talked about inflation, and we built upon that theme, saying it was going to be a bit more sticky and persistent than others felt, like the Fed, and so we have been early on this call, and we've added to that over the course of the last 18 months. And we may recall our video of a few weeks ago talking about regime change, how the last 40 years of lower inflation, of disinflationary circumstances that are unlikely to be repeated again for a host of reasons, led to the decreasing of interest rates and the fact that the Fed was at your back, pushing investors along. Any problems, they took care of it. The Fed put, and that whole 40 years had been a wonderful place to be investing. We think it still is wonderful, but very different. And this is what we're looking to try to communicate to our clients. So new regime is that difference. When no longer at our backs, need to be more active and engaged. Know what you own, know the thesis, know the numbers. We've always suffered the numbers. And that's why, during the heavy, frothy growth periods, we underperform, because that's not our game. Our game is to understand very, very strongly the economics and the financial analysis behind the companies that we recommend. We think we're getting back to an environment like that. I say here more of a Louis Rukeyser market than a CNBC, and that's just paying homage to the Wall Street Week host of many years ago and his very stoic approach to financial analysis and market sentiment. And so I think we're going back to that, where fundamental analysis matters and more. And to that end, we look at companies that are more resource-based, with pricing power and commodity exposure. We're more cautious on long-term bonds and high multiple stocks. Okay. And this is the chart that we spoke about in the recent past, and how this was the 40 years of disinflation, and now we have a different ball game here. So the inflation backdrop, it's insidious, folks. It creeps in, and once it creeps in, it gets its claws into the psyche of the market, and that's where we kind of are today. And I think that's why the Fed is being so aggressive in their views with respect to inflation and raising interest rates and squash it down. Powell does not want to become a Arthur Burns. Arthur Burns was the Fed chief in the 70s, and the mistakes that he made was start and stop. He didn't smash inflation. He wasn't resolute in his efforts to smash inflation, and he would backtrack and then lower rates. And that's when inflation was able to keep percolating. And then, of course, the energy crisis came about. And then, of course, we were off to the races with inflation being very high. So I think Powell, and I think also the Fed, was caught on their back foot with respect to the fact that they were not early enough on this inflation call. There's possibility with the wealth decrease. There's a possibility that the Fed begins to pivot slightly. I don't think this is in a 2022 type of time frame. Perhaps it's a 23 early, where they start saying things like, let's see the economy's responding. Obviously, the markets come down. There's been a lot of pain and bloodshedding, and that might be enough for them at the Fed to say, okay, let's just take a look at this and see how things look, and there's a lag to the impact. So we'll see if that occurs. This is a chart that talks about commodities as being potentially a place to be, as you can see here in high and rising inflation. You want to be in commodities and gold. Gold has not done well in this environment, which is unusual. That's likely because of the dollar, and that could very much, reverse. So again, very similar. You want to be an energy sector when you have high inflation. So these are the types of things we've been focusing on, of course. Food nationalism is also an inflationary play, in the sense that countries now are being more interested in keeping their output domestic. So part of the anti-globalization call that we've been talking about. Okay, so where do we allocate? What sectors are attractive? So the first, we look at liquid infrastructure. So we say liquid infrastructure because we want to make sure we're not talking about private equity kind of infrastructure investments. These are investments that are companies, stocks, and we've talked, of course, about the water infrastructure for the longest time, and it's still top of our list. But here you have communications, midstream energy, utilities, transportation. Why do we like them in this inflationary environment? Because they have long-lived assets, and because of that, and because of the predictable cash flows, long-term contracts with inflation riders. That's the key. So think of an apartment building, and you have these renters that come in, and every year you get to raise your rent, keeping up with inflation. Similar that you would have with infrastructure. That kind of having the pricing power to continue to do well and keep your margins high in an inflationary period. Also, real assets like commodities and to a certain extent real estate is also an inflation hedge. Again, here's a very similar slide what we talked about before, about the 40 years and then the new sort of inflationary period. Commodity super cycle. We do think that we are in the beginnings of that, and that's largely due to what we've been calling greenflation. And greenflation is the fact that we have these metals and minerals that we need to get us to net zero, and we have very little of them, and now we have increasing demand of them. And the reason why we have little of them, I'm talking copper, aluminum, iron ore to some extent, nickel, lithium, is because we've spent the last 10, 12 years avoiding production, reducing CapEx. Well, we had the ESG movement, and the industry was in the crosshairs of that sector, and no government really wanted them to do this, so they didn't. They just milked the cow, and they didn't invest in their business and their supply of their resources. And now we have increasing demand, low supply, ergo inflation. And we think that greenflation, and here's a slide that really speaks of it, on how much we're going to see, we're going to need investment-wise over the next 15 years in these products and these minerals. So, we must address the climate crisis. We must get to net zero. There's no going back to that. Hundreds of countries and cities around the world have said the time is now, and it's going to cost. It's going to be expensive. And I think it's going to be part of this inflationary spiral. And this is what happens when low CapEx and low investment for many years meets increased demand from the net zero movement. Something must give, and that's why we think inflation is likely continue to be likely, especially in that sector. I mean, it certainly will moderate a bit, and we'll see that in the CPI tomorrow. We probably see a little bit of a little bit of moderation, but still high and persistent and insidious and stubborn. And then I think in certain sectors like metals and commodities, we're going to see a continued inflation. And here's the amount of capex, how low it's been over the last few years, and that's what's causing in part this supply imbalance, and of course the huge demand. So copper demand, very same kind of thing. Copper is really interesting because it has not been a new copper mine in 25 years. And so really, and of course, copper is ubiquitous. You need it for all these electrification of our economy. And again, this speaks to exactly the idea of greenflation and the movement. Demand's accelerating. We've had an underinvestment in supply. Boom. What do you think's going to happen? Now, of course, we have electric vehicle demand. You're not reading that chart wrong. It's 65% CAGR out to 2025, and that's only a few years from now. I read something just recently that some analysts had said that every new car in America by 2020, I think it was 2026 or 2027, was going to be an electric vehicle. I mean, that's astounding. And so, of course, we're going to see a lot of growth. And rather than investing in the very volatile and likely overvalued electric vehicle makers, we've chosen to focus more on the Pixes and the Axe companies, the companies that build out the electric grid. And we've got several of them in our buy list, and we'd love to chat with you about them. This is not going away, folks. This is here to stay. And this is a business that's going to have a lot of growth behind it, and it's going to be inflationary. And here's another example of all the different minerals and metals that go into it. And we have a fraction of the supply we need. So with less supply, because of less investment, and now increasing demand, that's it. And how that works through the economy is still yet to be seen. But clearly, I think it's going to be a stubborn inflation environment for a while to come. We see these slides are almost buzzing through these, but you could focus on them on a replay. But yeah, same story. As we move to net zero by 2050, we're going to have a lot more green inflation. Okay, so our current playbook. We have a playbook. I don't want you to think, folks, that because of this inflation call that we've been early on and continuing with, and we're modifying it slightly here and there. Now it's more focused on this greenflation. But the bottom line is we still see a wonderful playbook ahead of us, but it's a playbook that's very 1973, 4 or 5. You know what I'm saying? It's the playbook that was used in the 70s when the inflation was similar to today, and it's never the same. What did well? Value did well. What did poorly? Overpriced growth. That's it. So we need to be mindful of valuation like that. Been talking about valuation extensions for a long time, and we've seen the extended valuation multiples. That's coming to fruition. They're right-sizing themselves. And yes, there very well may be some wonderful diamonds in the rough amongst the rubble there, and clearly we're doing that. We're looking for special growth situations where we could buy a good growth company at a fraction of its former multiple. But bottom line is you want to be more value. You want to overweight cash because you want to respect the volatility. With this environment, we expect, and we've seen, of course, a lot of volatility in the markets. And therefore, we want to respect volatility. And how do you take advantage of that? How do you use the volatility to our benefit as investors? We overweight cash. We feather in. We have a buy list that we over-research. We do a lot of fundamental research with some technical overlays, and we look for our buy list, our favorites that meet our thematic approach, and then we buy them. We buy them when they're being thrown out and it's indiscriminate selling and it's saying, get me out. Okay, we'll buy a little. And now we're buying, high free cash flow yields. We're buying dividend paying, oftentimes blue chips. that we've done the research on, and we're buying them at good prices. Not suggesting they're at the bottom. That's why we feather. That's why we feather. Okay? That's how you do it. We're underweighting fixed income. We want to be cautious there. Stay shorter term, stay high quality, if at all. Again, dividend growth, value style, high free cash flow yielders. That's where we want to be. On the sector sides, again, inflation centric. We talked about real assets, infrastructure, resource companies, commodities, companies with pricing power. And again, can't hear from me without me saying the water sector is something that we can't ignore. You know what's happening. We're running out, demand is high, and we need infrastructure in water. Okay, but lest you've forgotten, timing does not work. So do not think for do not have the belief that we could time this thing. That's why we feather, right? That's why we take our time and put capital to work. It's not a thing where we say, oh, get all in and get all out. That's nonsense. Because look, if you just miss the best 50 days out of, oh, this is 19, how many days is this? It's got to be thousands, right? And if you just miss the less than the best 50, you're down 1.7 versus per year. This is the average annual compounded annual rate. That's huge. This slide's even better. 952,000. This is a hypothetical growth of $10,000 invested in the S&P, right? 1980. Okay, so if you stayed in, you did a Rip Van Winkle, you woke up in August 31st of this year, 40 years later, you had 952,000 from 10,000. It's pretty cool. So, that's a nice number. It's probably close to 10% per year. That's the average of the S&P. However, if you were, brilliant, and you thought you were brilliant, and you were timing, and you got in, you got out, and you happened to miss just five. Out of all those days, 40 years worth of market days, you missed five. The best five. 590. If you missed just the best 50, 68. This is unimaginable, the impact of this. That's why we want to keep our core portfolio well-researched, understand the macro picture, and then around the edges, we manage, we tweak, we feather. That's how you invest. 60-40 no longer works. We've talked about this a few years back in the endowment pickle piece. I'd say that 3 times fast. And in that particular piece, we talked about how endowments, which are typically 60-40, philanthropic portfolios or nonprofit endowments, pensions, etc. They're typically 60-40. And yet, because of the fact that the fixed income portfolio has given us nothing for the last few years with the low interest rates, many folks are trying to become 90-10 and go more towards equity. And that's, of course, very risky. So we think it's probably a time to be more allocated in overweight the cash, be cautious on the fixed income, and then, of course, your equity exposure, be more inflation-centric and be more particular to the resource companies and the value style that we talked about. Where are the opportunities hiding? And there are opportunities. There always are. That's what makes this job so exciting, is that there's always an opportunity, but you've got to be keen, you got to be skeptical, you've got to do the homework. This is not a market to throw a dart against the wall and buy the prettiest ETF and become a winner. That worked over the last 15, 20 years, maybe. No more. That game is over. We're back to that Rukeyser-like, that Wall Street Week kind of fundamental analysis. Got to read, got to work, got to do the numbers. So we've done that, and we believe that valuations on high growth companies, not yet, but they've certainly come down dramatically. So they're on our research. We're researching them. We're looking for the companies that might have a great addressable market, with great management and a great product, and now they used to be up here on the valuation, and now they're down here maybe. So you feather in a little bit, perhaps. Also, this is similar. This is the top 40 S&P 500 companies taking out financials and real estate by their long-term, the last 12-month free cash flow yield. So you're talking about, versus the S&P. So these companies are, they've come down a bit, and now they're picked up. This is a very good free cash flow yield. So this could be interesting. Energy's still cheap. We've talked about this for a while now. That's been one of our earliest calls on the energy sector. And again, for those of us who are for whatever reason, and we respect this, of course, who do not want energy exposure in their portfolio, we've got a solution that's called water. It provides you with the ESG modifieds you need or want, but it also gives you that resource and inflation-centric sector that is still attractive. Looking for opportunities, we're finding also in pockets like Japan, very interesting. Japan topped out in 1989, and they're still 30 or 40% below. I mean, it's dramatically undervalued over the last 40 years. So maybe they're getting to be a point where they're changing. So we're looking at that as being an opportunity. Emerging markets is also ex-China. Even China is interesting, but they have such issues where we're not sure we want to stick our toe there yet. But emerging markets is interesting. Of course, the war and the dollar strength is causing some issues here. So it's on a back burner for us, but we're watching it. European stocks, we're talking about blue chip European companies that have been around forever. Here is, these have opportunities as well. Small caps are cheap, very cheap. Small cap value especially. And with respect to the foreign exchange risk, we don't see that with small cap because they're mostly US-based companies. They don't have the multinational footprint, so therefore they don't have the FX drag. So that's interesting. And again, we talked about how value style it's been all growth for so long, but we think there's an opportunity, much like there was after the .com crash, and value resurged, because value does, you'll see in a moment, they do very well when inflation is high. So history says buy inexpensive, high quality small caps, and then sell low quality small caps when the Fed hikes. So you want to stay high quality and value centric. And here's the slide I mentioned about how value is done well. The bottom 20% of the stocks by PE, ergo value, right? And therefore you could see even in the difficult 70s how the value style did nicely. That's it, folks. I appreciate your time. Sorry to go through this quickly. I hope you are well, and we're here to help you. At Align Wealth, we take our work very seriously, and we hope to continue to provide you with the important analysis of your portfolio, an assessment of your risk tolerance, a review of your financial plan, your comprehensive wealth management plan. This is what we do for our clients. We're here to do it for you. Please contact us. We're happy to help. Thanks a lot.